Hey everybody, Jason here. Happy Tuesday. Hope you guys are all having a great day. As you can see, we're having a pretty good day on our account of 7-ish thousand, 6, 7,000, something like that today. So pretty good. Today made a few plays. One was continuing to get out of put credit spreads and plays that are not on Tesla or I guess leaps on Palantir or on the wheel on Tilray, no matter how bad we're getting slapped around on that one. But that one we'll just keep playing and see how it goes. Let's see, we exited our Google put credit spread and we exited our Roku put credit spreads. Should have exited them yesterday. Could have taken some more profit, but oh well. Just got rid of them. Still did take some profit. And what I did is I wanted to take that same premium I just paid back, what I paid to close those, and then open them up in Tesla put credit spread, something that I'm 100% comfortable with, as opposed to the Rokus and the Googles. I don't have an expectation for Google in 7 years or Roku in 7 years or even 6 months. I don't know what really affects it except for overall stock market. Tesla, I do know. So that's what I wanted to do. Take that collateral, use it in Tesla. So that's one of the things that we did, and I'm not sure if we're up, down, sideways on them. We are up a whole $6 on them. So these are pretty close to the money. But as far as confidence compared to having my money and even being down on it on Roku and Google, I'm much more comfortable right here. I know kind of what to expect, and I know I can roll these out much farther if I need to, and likely will collect some more premium, but I'm so much more confident in these, even though they're super close to the money compared to something like the one above where we're super far out of the money. And good Lord, do we even have any money to collect here? Oh, still $60, man. Oh, but it's on a $10 put credit. So I was like, $60, that's like free money there. Do that. And if it was $60 for a $5 wide one, it'd be like, yeah, that is investing advice. But so we got rid of those and opened up those couple positions. I opened up our SPY put credit spreads here, 427s, 426s. I had opened up 9 originally, and then I forgot that I wanted to start doubling down on these, or put twice as much collateral towards playing these guys as I closed out some of my other plays. So we got one fill, and it kind of worked for us. So we got one fill at $7, came down a little bit, and we opened up another 9 for an additional $10. Our average fill price $8.50, and our plan with these are one of two things. We are either going to close at $1, which we put a good till canceled order in to close at $1, or if it happens to go against us and this number becomes 17, we'll close it as well, which is twice the premium received. So this is super important. Why? Because we can't just let it go and then go, like, what do we do? What do we do? And we have a very methodical approach to these. We need to be right 3 out of 4 times to be profitable on them. 2 out of 3 times or break even or somewhere around there, just depending on the actual credit received, etc. So one of the comments was like, what do I do when these things go against me? And right now, I think the plays were at, someone's in the comments, their plays were at 434, 433. You do have your 3 options, which is close it for a loss. You can roll it out or let it ride. So depending on what you think is going to happen, that's what's going to determine what you do next. So if you think we're going to stay at this level and stay above your strike prices, there's no reason to close it. You could just let the thing roll and decay a bit. You could close it out, take your loss, which I believe would be about 2.5 times your collateral, which isn't too bad. A lot of people do 2 times, 2.5 times, 3 times their collateral, close it, and then try again next time. You won't be getting all your collateral back, but you'll be preserving 70% of it instead of potentially losing 100%. And that's where you don't want to be. you don't want to be in a place where you're forced to close it for a night, like a 90% loss or anything. You really want to manage the losses to the downside. And your other option, of course, is rolling it, and we can show you how to do that. That is pretty simple, which we just go in here to trade, view all options, and let's say this thing had moved against me, and my thought process was that we just need more time and then the SPY will go up, which probably will happen. I mean, over our long term, we can see what it's done in the year. Yep, we're having a little bit pullback here, but just overall the thing does go up. And just depending on what you want to do, really dictates how far out you want to roll it. You could roll it out a couple weeks, a couple months, roll it out longer. But it sounds like you're only playing with $100 collateral, which isn't the worst thing in the world. And even if you took a loss at this point and your loss is what, $20 or $18 isn't terrible. So, but let's say, for instance, we do want to roll these guys out. Basically, we just find the spreads that we have here. This is going to be one way. Buy back the 18, switch over to sell, go find that again, sell back the ones that were positive on, the ones that we bought, and then let's say we want to give it another week, so we just go a week out till next Wednesday, and then we can roll it out to that same level, the 427s, and we can buy back the ones below it, the 426s, and as you can see, in this case, we would collect an extra $12, $13, probably get filled at 10, but we actually collect some more money because of the extrinsic value, because of the time. And it's basically that rent, essentially like a rental fee for your cash. You're putting your cash on the line for another week, and that's what you get for it. So if that's your thesis, that's one of the things you can do. Another way of doing the exact same thing would just be hitting trade and close, and you could close them out for whatever you could get and then just open up another one. Essentially, that's the exact same thing as rolling, although it doesn't really keep your your profit or your loss relative to the underlying. So there definitely can be some movements within that minute or two. I mean, I guess movement can happen within seconds, so it doesn't really keep that there. I just prefer to do it all in one move. That's just what I've gotten used to doing, and it's just it's pretty simple. And that way I'm not waiting for not only the closing order to fill, but the opening order to fill. I'm doing it all at once and then grabbing the credit I want. Now, if the SPY was down quite a bit more, so let's say the SPY was down at the 427 something, I'm not going to be able to gain quite as much premium for rolling it out. And if the SPY was down at 426, 425, we probably would have little or no value left to be able to roll those out, because we only have 1 day till expiration. And that kind of runs into something else that people ask about, like why open things up 4 to 6 weeks out as opposed to a week or two out. And there's always just going to be trade-offs. There's never ever going to be like the best way of doing something. Opening them up a day out, a week out, or something short term, you're going to be able to roll that collateral over again and again and collect your premium again and again. Where if you open them up longer, you're not going to collect as much premium as fast. But since you do have that extrinsic value, basically what happens if that trade goes against you, and 2 similar trades, one being 4 weeks out and one being 4 days out, the one that's 4 weeks out, since it has so much time to do things, that one's going to have more value than the one that's short term, because extrinsic value is essentially time. So recognizing that the one with more time is going to have more intrinsic value, and just value period, that's basically the money that you have to do something with. When you have no value in the play, so let's say these go down and it costs us 90 cents to close it. If we're at that point, meaning we only have $10 left out of our $100 collateral to do anything with. You're not going to be able to do very much with that at all. And that same play 4 to 6 weeks out, you may have $40, $50 where that's enough to actually do something with. And you also you're buying yourself more time for whatever else to occur. If it's staying the same, bouncing up, bouncing down, just being in an area of more comfort. It's all relative to what your plays actually are. So hopefully that is helpful. The one other thing that I did today is I did buy another Palantir Leap, which I'm down $7 on, but I grabbed a January 2024 Palantir $20 Leap. One thing I was noticing today on Palantir, was it the 1 year? It is the 1 year chart that I was looking at, but I noticed we have higher lows. Oh no, I didn't want to do that. Let's oh, I see what we did there. So Palantir, let's see if we cannot do that. I'm noticing that is pretty much the trend for Palantir. And yes, we've had the little pop-ups and this kind of thing, right? But overall trending up. And when I compare that to another favorite stock of mine, I don't know if you've heard of it, Tesla. Kind of have that same thing going up where we have these same little pop-ups, but it's following that same nice trend and that big overbought area. So I see that same exact thing happening. My money is where my mouth is. Pretty much all in on Tesla across several accounts. It's actually pretty cool to see the last few days, right before the last big Tesla dip. Boy, when was that? I think it was like February when it was, I can't remember which side it was on. If it was right before the end of the year or like February-ish before it really started to dive down. But I had grabbed on another account 200 shares at $800, just going, man, like last chance. It's when they purchased their Bitcoin kind of thing. And now we're finally positive after 8 months of waiting. But overall, 8 months, it's not that long in investing terms. Like we're not trying to, I mean, it's nice to make this money short term, but most of us are investing to try to quit our jobs, apparently, according to the polls, or build up a retirement, or like just supplement things. And that definitely doesn't have to happen overnight at all. And my last little thought of the day, something I saw posted on Twitter as a response to somebody else who's pretty much all in Tesla, was that diversity, or the not having all your eggs in one basket. Yeah, just a diversity of portfolio equaled indecisiveness, and that just kind of that rang true with me, and essentially aligns with what I'm doing here. It really does. There's no reason for me to have my money split amongst 10, 20, 30, 40 companies. I mean, just by owning some SPY shares, it's diversified. And I do have other accounts where it's a bit diversified. But as far as this one, and I'm making the same move on some of my other accounts too. I mean, I don't need to hold a low dividend paying account or stock for the long term. I don't need my 3Ms or my Johnson & Johnson. I really don't. I want my money to grow, so the only thing that makes sense is growth stocks. Anyways, I know this video is a little bit long, hopefully helpful for somebody. And with this big update, this big jump in this update, I thoroughly expect a pullback over the next, couple days, maybe a week or so. We usually don't have these massive ups without some downs, so there's definitely going to be some more opportunity to open up some high premium paying put credit spreads, in my mind, unless we roll right into earnings and something's like just fantastic and keeps going up from there. but I think we're right. We're right perfectly in line where things should be, just kind of moving back and forth along a channel. All right, guys, love you. Have a great day, and let's make a lot of money.